Hi, everyone, and welcome to another episode of UBS Trending. I'm your host, Anthony Pastori. Despite the continuation of the COVID-19 pandemic, the global economy seems to be on some pretty solid footing. Investors, however, may be seeing it differently. There seems to be some market skepticism out there, and the question is it because investors have become more accustomed to cycles of slower growth? Is this cycle different than other recoveries in history? Well, joining me now to talk about this and talk about where you should be investing in this environment are Evan Brown and Nicole Goldberger from UBS Asset Management. It's so nice to have you both on the show. Thanks for being here.
Thanks a lot, Anthony. Great to be with you.
Of course.
Yes,
Evan,
thank you, Anthony.
Thank you, Nicole. So, Evan, let me start with you because this is something that I want to ask you. Your team recently published a piece that is titled, "This Cycle Needs a New Playbook." And right in the tagline, you talk about how you believe this expansion is actually poised to deliver stronger growth than what maybe investors have become accustomed to. What do you mean by that? And how is this different than some of the other post-financial crisis recovery that we've seen?
Yeah, that's right, Anthony. So how is this cycle different? We think economic growth and inflation are both going to be structurally higher this cycle versus the last one. If we compare this recovery versus the one post-global financial crisis, there are three high-level ways in which this cycle is different. The first is the starting points, the consumer and corporate balance sheets. Of course, last cycle, there was a need for the private sector to delever, to reduce debt. Households and banks in particular, which was a major headwind for growth really for years. This cycle, balance sheets are flush with cash. Consumers have excess savings to put to work, and many corporations have really mountains of cash to put to work as well. Second, last cycle, there was fiscal austerity, right? Governments immediately moved to reduce budget deficits. And this time, as we all know, governments have put a ton of stimulus into the system. And crucially, they're not really pulling back. So at a minimum, fiscal policy is not going to be a headwind for growth. If anything, a boost for economic growth. Think of all the green investment that is happening globally to get us to net zero carbon emissions. That's an enormous amount of spending that we just didn't really have last cycle. And then third, which is related, is that there's very little private sector CapEx last cycle, but COVID has made us very aware of supply constraints globally, right? And as part of that, a desire to onshore investment. So there's less dependence on what's happening in other areas of the world. So there will be more domestic investment to ensure those more reliable supply chains. And while over the long term that increases productivity and can reduce inflation, in the short term the extra spending is highly inflationary. So all in, those three factors are the ones that make us think higher growth, higher inflation over the course of this cycle.
Right, and Evan, so clearly Omicron came as a bit of a shock for most of the planet. We didn't really see it coming, and especially as intensely as it did, especially during the holiday season. So that was certainly a tough time for most of us. But let's assume that it peters out in the next couple of weeks, which some scientists are looking towards. What are the other risks that are out there? You still have supply chain issues. You've got inflation that people are concerned about. You still have labor shortages that are out there. What do you see as the main risks to your outlook from an economic point of view?
Yeah, and I think it's what you just really referenced is high inflation. We're more concerned about really high inflation forcing central bank tightening than we are about a major growth slowdown. And let's be honest, markets have benefited enormously from the Fed and other central banks keeping rates extremely low. Now they'll be tightening. Right now, expectations for how many rate hikes we're going to get, they're still pretty low. But we do see room for the market to price in a lot more tightening from the Fed, especially if inflation continues to surprise to the upside. You also mentioned COVID. I mean, we're all hoping that Omicron is the last major wave, and due to its contagion, we'll have more herd immunity. Plus, we've got the antivirals coming to support vaccines and reducing the severity of outcomes. But as long as the virus lingers, there's possibilities of more mutations, and we're hoping that there's less and less severity over time, and that's been the trend so far. There's of course always a chance of a mutation that is more dangerous. What's interesting about COVID that we've learned is it's not just something that weighs on growth, but it puts upward pressure on inflation. So that comes back to the first risk, because of those supply chain issues and the shift in demand towards goods over services. And of course, slower growth and high inflation is not a good mix for markets. And I'd say, finally, the last risk that we're looking at is China. China's economic growth. There's still this property sector crackdown going on. The increase in regulation on technology that we saw last year, that's not going to stop. These are multi-year trends. Now there is stimulus coming in China that's going to cushion growth, but it's a very difficult balance to manage these headwinds and make sure there's adequate support. And of course, with China being the second largest economy, how China goes will have a sizable impact on what we see on a global basis. So that's what we're focused on in terms of risk this year.
Great, thanks, Evan. Yeah, clearly, as you just stated so clearly, there are so many uncertainties that are out there. So it's the best thing to do is be prepared for any scenario. Clearly, your outlook calls for slightly better things coming down the horizon. But Nicole, let me bring you in. It's so nice to have you. And look, as the head of portfolio management for UBS Asset Management's multi-asset offerings, let's talk about how Evan's outlook then translates into how you're recommending clients position their portfolios. Like, what assets are you actually finding attractive right now, given what the expectations are?
Thanks, Anthony. So given our positive outlook on the global economy, this translates into having a risk-on, more pro-cyclical tilt in our client portfolios today. We are tactically positioned to benefit from an environment where growth stays stronger for longer. Growth stays above trend, and this should ultimately bode well for risk assets. So in portfolios, we continue to be overweight equities. We're emphasizing cyclicals over defensives and value over growth. We're also underweight bonds. We see real yields today as too low. So we're expecting higher real yields to play out in 2022. Within equities, we see the most attractive opportunities in those regions and sectors that are most levered to this pro-cyclical theme. For example, we have high conviction in Europe and Japan, particularly given that both these markets are structurally more skewed to cyclically oriented value sectors. They also offer the upside potential for economic and earnings growth. In Europe, for example, we have more fiscal support coming this year, and we have a solid private sector recovery, all of which is supportive for European risk assets. From a portfolio construction perspective, we like funding these overweights to Europe and to Japan from another cyclical region, emerging market equities, which we continue to dislike. Emerging markets will likely face headwinds from higher real yields, a less favorable earnings backdrop, and uncertainty around China. And let's not forget about the US. Despite delivering a 29% total return in 2021, leading the charge in global gains, we continue to favor the US in portfolios. The US economy will still be quite strong, and the US consumer will remain very resilient. We focus on being nimble, though, within US equities, meaning our top sectors are financials and energy, and we like US small cap equities and the equal weight index opposed to the S&P market weighted index. And lastly, on the fixed income side, we are underweight US investment grade credit, our least preferred credit market, where I see more asymmetry to the downside, given very tight spreads and more duration sensitivity. Instead, we prefer other select credit markets at the expense of government bonds to take advantage of the higher yields. We certainly see the trend of investors searching for yield, that demand for yield will continue into 2022.
Great, Nicole, thank you. So I do want to focus a little bit, especially for our viewers here, on some of those risks that Evan had laid out. And I know you haven't gotten into China yet when it comes to your investment recommendations, considering their destabilizing downturn in real estate. So what kinds of risks are you seeing from the investment side, and how are you and your team looking to mitigate those for investors?
Yep, great question. So, Evan has already laid out the risks that we are closely monitoring. And as portfolio managers, Evan and I are laser focused on all of them and how each one impacts our portfolio construction decisions. So I think it's worthwhile for me to highlight how we're thinking about hedging against our number one risk, and that's higher inflation. This was a hot topic in 2021 and will continue to be a top of mind for investors this year. So when you take a step back and look at the bigger picture, you see that we've gotten very used to a regime where inflation is well anchored and quite muted. But the risk today is that we pivot to a world with more sustained inflation, right? Meaning inflation remains higher than expected for longer beyond just a transitory pickup. Now, this type of regime shift would push the stock bond correlation from negative to positive, so into a more positive territory. And this would prove to be disruptive to both stocks and bonds during a downturn. It would be very tough to hide in that type of environment. While this is certainly not our base case, we are focused on mitigating this downside risk by further diversifying our portfolios. Specifically, what we've done is we're now favoring commodities and REITs as an inflation hedge, while also going long energy within our equity allocation in portfolios. Also, it's important to note that in a world of beta selling off, I want more alpha in my portfolios. So seeking diversifying active managers is also very important. So I think, while we certainly have high confidence in our outlook for above trend growth in 2022, we acknowledge that there are risks to our views, so we remain nimble and ready to pivot and change our portfolios as the market environment evolves.
Terrific. Evan and Nicole, thank you. I appreciate both of you providing your transparency here. And obviously, investors are always looking for the next thing, especially as we kick off the new year. So good to see the good, the bad, the in-betweens, and what you're looking out for. So thanks for joining us today. Good to see both of you.
Thank you.
Thanks, Anthony.
Take care, guys. Happy New Year. And for more information on anything we spoke about today, you can find a lot of content on our website, ubs.com/views. And make sure to follow UBS on various social media platforms, as well as checking out past UBS Trending episodes completely on demand on YouTube, as well as our website, ubs.com/studios. And as always, if you have any questions about your own portfolio, make sure to speak with a financial advisor. Until next time, I'm Anthony Pastore. We hope you have a great day, and remember to keep your eyes on what's trending. We'll see you soon, everyone.